see what we got here. Let's see what we got. What else? Barb 461. All right, folks, let's get a sound check. Can you guys hear me okay? Say yes, and just press, just give me a yes in the chat and just say yes. Can you hear me okay? All right, great. So let's get this meeting started. And my suggestion is that, as always, ask as many questions as possible so that way we can make this as informative as possible. Ask whatever you want. I'm just going to do this off the cuff like I always do. I'm going to go through some things, maybe go over some stocks, and then we'll take it from there. So first and foremost, what I'm going to look at is my rolling 5-day watch list. I'm not going to look at the indices only because I believe looking at the indices for the most part is a complete waste of time. That's just my opinion. Looking at the indices on a daily basis, in my opinion, it's a complete waste of time. And the reason why over the last few months, we've seen the action for the most part underneath the surface. It's been horrible. If you take a look at something as basic as stocks above their 40-day moving average, it's 43%. The NASDAQ is printing new highs, but yet we have less than 50% of NASDAQ stocks above their 50-day moving average. So if you're out there looking at the indices and saying, oh, everything looks great, but my stocks are not working, that's the reason why you don't look at the indices. I haven't seen this type of divergence in a very long time, and it hasn't mattered. Hasn't mattered at all for the most part. The indices remain undefeated, and that's the reason why um, that one post or that one video that I have, which is owning the core ETFs as core holdings, is for times like this, where the indices are just slowly but surely grinding higher, uh, and then the individual stocks are not doing much. Okay. So the rolling 5-day watch list and my recent trading tells me all I need to know in regards to what's going on in the market. And to be quite frank, the rolling 5-day watch list has been, you know, maybe if I had to grade it, a D. Okay, some stocks are moving, some stocks are not. Uh, they have not been moving much. Some of them have been one-day wonders. For example, UPST right over here had a nice little breakout, uh, goes up about 10 points, but then fades. You know, started off okay and then faded. Um, this was when it was okay, but here the stock has a beautiful breakout down 3 days in a row. It goes up roughly, 25%, which is more than enough, actually. This is more than enough. 25% since the trigger. Not bad at all. Sumo was fake out breakout. MYGN, which I still own, still doing okay, 5-month base. But either way, this is what, if you want to know what's going on with the market, number one, you got to go through the rolling 5-day watch list and your recent trades. Now, when you go through the rolling 5-day watch list and your recent trades, specifically your recent trades, you have to be honest with yourself. You got to make sure that your recent trades don't, for a lack of a better word, don't suck because you've been mismanaging the trades once you get in. That's very important. Okay. We all get the same list every single day at the same time with the same buy stops and the same sell stops. Execution of those trades is what makes the difference for the most part. And execution means putting the orders in. Execution means if you did not put an order in. Execution means sizing it correctly. Execution means not choking the trade. So all these things are important. So you have to be honest with yourself when you go through the rolling 5-day watches in your recent trades that you're not making the market choppy because of your execution. That's very important. You got to make sure that you're honest with yourself. Like for example, Amazon, I thought it was a great trade. I didn't take this trade. That is a mistake. It was right over here. Going through 34.56, buy stop 34.56.13. Okay. So that's important. So now what we're going to do is first question, thoughts on Apple and the banks. Yeah, you got to be more specific than that. Apple is Apple. What's your time frame? Do you have a short-term time frame? Do you have a long-term time frame? The banks, or you're talking about regional banks, talking about JP Morgan, Goldman Sachs. If you own these stocks, Apple and the banks, if you own them, then have a plan. Okay, you can see Apple here has been trading sideways for a while. You can call it going sideways for roughly 10 months. Okay, this could be a big breakout. If you believe in stops, then maybe you want to use a 21-day moving average as your stop, as your trailing stop on Apple. Apple's been trading sideways for 10 months. Normally, a stock has been trading sideways for that long. Once it breaks out, it normally hasn't moved. It'll last for a few months. If you take a look at similar setups recently, Docu sideways for 8 months. You take a look at NVIDIA, very similar situation, sideways for 8.5 months. Goes finally breaks down and continues to go. Their CRM might be ready to break out. So when you're looking at something like Apple that's been basing for a long time, for 10 months, it's a very long time. You want to give it some room. These big cap companies like the Apples, like the Google, um, and all the, for the most part, all the QQQ names, they tend to respect the 21-day moving average, which is right here, the yellow line. And once they start to trend, typically this moving average for these Russell 1000 names, the high big growth names or big cap names, for the most part, they respect that average. So my suggestion is you're long, stay long, use the 21-day as a stop on Apple. As far as the banks are concerned, I don't know what you own, but whatever. Goldman Sachs, JP Morgan, same thing. Uh, there are two type of stops for the most part that you can use. You can use a short-term stop, a very tight stop, and a very wide stop. They both have different. Uh, they number one, they're two different time frames for the most part, and they serve two different purposes. A short-term stop, for the most part, you're stopping yourself out within the noise, but you're keeping it tight. And if you don't have an issue taking stops on a consistent basis, short-term stops might work for you. Tight stops. If you have a tough time taking losses, okay, for some reason you don't like taking losses, uh, you like the one-sided trades where you buy it and you're not going to sell it unless you sell it at a profit, then my suggestion is that you use a wide stop. A wide stop means a 20 to 25% stop. Something wide, allow the stock to go up and down, up and down, up and down. I would suggest a trailing 20 to 25% stop that moves up as the stock hits a new high. Say, for example, if you own the stock at 155.77, this JP Morgan, a 20% stop is roughly 124.61, all the way over here. What you want to do is you want to price it, you want to size the position correctly. So you take 155.77 minus 124.61. If you want to risk 1% of your account, you take whatever 1% of your account is, divide it into the difference between your buy price and sell stop. Now, as the stock starts to move higher, from 155.77 to 156, that trailing stop is going to follow the stock price higher. Okay, and that's great, because if it goes up immediately, that means that right off the bat, you're pretty much almost in a winning trade, because now you're losing less than what you expected to lose if you were to get stopped out. Okay, so as far as the market is concerned, we have the indices. Again, they remain undefeated. They're trading near highs, but stocks underneath the surface, they're not acting great for the most part. We get these little, from February to May 20th, May 25th, it was horrible. We got this little 2-week action, which was great, 2 or 3 weeks. I was in a drawdown from Feb 10 until May 25th, I think. 2 to 3 month drawdown. That little 2-week window that I showed you guys, I made up that entire drawdown in a matter of 2 weeks. Not even with my regular size, small size across the board. So once you get that out, so listen, the market, we're going to go through. Let me just pull this up again here. I know I posted this numerous times. So here, we're going to go through this action over and over and over again. It doesn't matter who you are. You can be George Soros, you can be ARK, KK, whoever it is, Kathy Wood. She just went through a tremendous drawdown. ARK is still down 20% from the highs. It doesn't matter who you are or how hot you were just 6 months ago. It's irrelevant. We're all going to go through this action, which is sideways action, sideways chop, regardless of what the market is doing. Then you're going to get a rip higher. As you get that rip higher, a tremendous move higher, you're going to get a rug pull, and then you're going to grind it out all over again. And you're going to repeat this cycle over and over and over again. What you want to do is you want to make sure you repeat this cycle at higher levels every single time. That's it. But what ends up happening is, for the most part, for most people, is that once they go through this sideways action right over here, they start looking for different strategies. They start going from this to this to this to this to that to this to this. Some guy said this on Twitter. This guy did this on Twitter. Now I'm following this guy. Now I'm doing the IBD strategy. Now I'm doing, wedge or whatever the case may be. And then once the market finally turns around, or, the market of stocks finally turns around, they miss all this. Or throughout all this, they lose faith. They don't put the work in, and then they miss all this. This happens over and over and over again. Or for some reason, they were worn out by the market, and when things line up again, they're too gun shy and they miss this move higher. Then they finally get involved right up here at the highs, just in time for a rug pull. It happens all the time, okay? And I know it's hard to see here, but here you see it over and over and over again. Sideways action, rip higher, rug pull, grind higher, sideways action, rip higher, sideways action, rip higher, rip higher. Here is a drawdown of this year. As you can see here, the bigger the move higher, this is what's going to happen. The bigger the move you have higher in the short term, when you really you really do well, you're going to sit through some type of consolidation drawdown for a while. You're just resting like anything else. If you run 4 miles, whatever the case may be, you might rest that 5th mile and just walk. The same exact thing in trading. All right. But what you want to make sure is that you're able to recognize the periods where things are not going well and you size down. And the minute you start seeing progress, then you start getting a little bit more aggressive over and over and over again. That's it. This is going to happen over. All I want to do is want to make sure that this happens at higher levels every single time. Do you have a favorite screen that you created in TC 2000? No, I mean, what TC 2000 is good for is for studying past periods in the market. It's great. It's great for scanning. It's got to be the best software out there as far as scanning is concerned. So, for example, on every single day, this is my main screen. This is all I have. I have the rolling 5-day watch list. I have my holdings, and I have here flag stocks, which means these are stocks that I throughout the day, if I'm going through charts and I see something, like for example here CRM, I caught CRM somewhere over here, and I'm saying, okay, this thing is actually developing. I see a base is not quite ready yet, so I'll flag it so that way I don't forget it. Okay, but here's my main screen. This is all I need. It's just my rolling 5-day watch list, just to see how things are going. And these are some scans. This is the 4x3 scan, my favorite scan right over here. Here is the top 400. What I do with the top 400 is that during the day, I put this one little criteria. Today's price is above the previous day high. And I do this throughout the day just to see what triggered, and just to see if for some reason, was there a trade or a setup that I missed that wasn't on the list. I want to make sure that if something triggered, I'll ask myself, why, if I had the right setup, why wasn't this on my list? Okay. Then I have here the inside days. What I do, sometimes we get a ton of inside days, and I'm going through the watch list pretty quickly. I'll put all the inside days into this scan right here. And the same thing, I'll put this one little criteria. Today's high is higher, or today's close, today's price is higher than previous day high. And this gives me all the stocks that went above the previous day high, which is my trigger point for all my setups. All my setups have to go through the previous day high for them to be actionable for me, okay? Here I have the stocks down 3 days in a row and up today through the high. Again, and this is all I do throughout the day. So these are the scans that I'm going through. Normally at 3 o'clock, I'm going through the entire list of the 4x3 scan. And what I'm doing very simply is I'm jotting down names for tomorrow. Knowing that this is a tough market, would you recommend just sit out and recharge or keep taking trades at a smaller size? That's up to you. Listen, when it comes to trading, you have to find something that fits your personality. Okay. So if you're fine sitting out, sit out, but you still have to do the work. Okay. You still have to come up with a list every single day. You can't just look at the market and say, okay, the indices are near high, so everything is okay. No, you still have to do the work and have a watch list and track that watch list to see how things are going. And then you have to write down before you do all this, you jot down what it is that you're looking for, or what it is that's going to make you step your toe in the water again. Before, people would say, okay, we're trading above the 50-day moving average, we're in. If we're below, we're out. It just doesn't work that way anymore. We're above the 50-day moving average, and stocks underneath the surface are just, for the most part, acting horrible. So you have to continue to do the work on a daily basis, and then jot down what would make me go back in and start trading again. And the fact of the matter is, nowadays you can trade small because everything is free. It doesn't cost you a dime. You can buy 5 shares across the board. And anyone who's struggling when it comes to trading, if you're struggling, I will go out there and buy whatever it is, 1 share, 2 shares, 3 shares, 5 shares, and just let things play out. Have a plan for those 5 shares. 1 share, I'm gonna put a stop at break even, good till cancel. The other 4 shares or whatever the other share, I'm gonna depending on the setup, I might use a 21-day moving average as my stop. The other 3, I'm gonna sell on the way up. Right? With divergences we are seeing between the indices and the individual stocks, are you starting to scale back on your core holdings? Right, core holdings mean that the SPY, the IWM. I've scaled out of the SPY, QQQs, IWM almost entirely. I can't sell anymore. If I sell one more time, then I won't have any left. So I can't sell anymore. So what Chris means is, I think, listen, I don't believe in trading your account and going to 100% cash. I just don't believe in that. I just don't. Not for most people anyways, not for 99% of the people out there. I don't believe in going from 100% invested to 100% cash. I think you got to keep something on. And I believe if you wanted to keep something on, I believe that the SPY, the Qs, and the IWM are the best things you can keep on, because nowadays, no matter what's going on, people judge themselves and everyone else based on what the market is doing, and that is the SPY. So if you're going to judge yourself based on what the market is doing, just buy the market, okay? And then you're guaranteed to catch every up and down, okay? I like to buy the SPY, the QQQs, and the IWM. The average intra-year decline since 1980 is roughly 14.5%. I like to buy them on the way down. I like to buy them once we get down 10%, 15%. I want to buy some more. Like, for example, and we haven't had a 5% pullback, I think, since October. So it's been a while. But for example, ARK, here, ARK is not an ETF, but I'm sorry, not an index ETF. But it's an ETF with stocks with growth, whatever, Momo stock for the most part. And this thing had a pullback it had roughly a 33% pullback. And here, 3.5 long, down 4 days in a row, down 30% from the 52-week high in 14 days. So I want to buy these things. If you believe in these things, you want to buy them on the way down. the index ETFs, and something like this, like an ARC, like a 50, the IBD 50. You want to buy these things on the way down, okay? And then just hold them for as long as possible until we're stretched to the upside. Then you take it off. The 4x3 scan, Tesla, Mr. Tesla. That's just one. That's my favorite scan for my time frame. I believe, in my opinion, that scan is going to produce. You will find the biggest winners in the short term, 5 to 20 days, in that scan. You won't miss a stock there. They're all going to come out there. So that's just that's my favorite scan. All right, so we have that. Let's go to the universe of stocks, and let's take a look at. Let's take a look at the best performing stocks year to date. Okay. People talk about reading books. You get a lot of information when it comes to books, right? A lot of ideas. I've gotten tons of ideas in certain books. But I believe that nothing gives you more information about what currently works right now than studying the best performing stocks on a yearly basis, on a year-to-date basis. This gives you all the information in the world. It tells you whether, what people are reading, whether it's true or not, whether, certain criteria that people use, whether that matters or not. It tells you everything. And you can, more importantly, you can build scans based on what you find, on the commonalities that all these stocks share, all the best performing stocks on a yearly basis. I mean, the video that I have that's 2 years old, whatever, no, 2017, these videos here, it's just the first 2 minutes, it says it all. Okay, first 2 minutes, what you have is a stock that's dead, hasn't been trading much, trading near a 52-week low. A lot of times they do a reverse split, and then suddenly news comes out, the stock goes up huge on tremendous volume. You get 10 to 15 days of sideways action. At the very end of that sideways action, what typically happens is that you get the volume contraction and you get the price contraction. The stock might print an inside day, and then it's off to the races all over again, right? That is a setup. When it comes to basis, when it comes to big basis, you're going to see, for the most part, the same exact thing. You're going to see a stock trade sideways for a long time. You're going to see the moving averages. They're going to start to hug, which means they're all within each other. I have this. So as I'm going through, through certain stocks, and I'm noticing all these bases, that's how I came up with the scan, which I call MA hugging, which is the moving averages are hugging. And what I did was I just wrote a scan, show me all the stocks that the 50-day, the 21, the 50-day, the 63-day. I have it here. Let's see. This is another stock. This is another one that I go through. Where is the MA hugging? Okay, here. All right, so the 50-day is within 4% of the price. The 63-day within 4% of the price, and the 20-day is within 4% of the price. So all the averages, and you see here, whatever, some people might call this a bow tie, but all the averages are hugging. So what typically happens when you see these bases, that as they're very near the end of the base and they're about to take off, okay, what you start to notice is a pattern of higher lows. Here you have up and down, then you start to notice a pattern of higher lows. And I'm going to show you a whole bunch of examples of these bases. And this is what you need to do. You need to create, I don't have, let's see here. You need to create these pattern libraries like this, Adobe, uh, sideways for a long time, MA Huggins, there's a pattern of higher lows. And that's when you know here that at the very end, it's almost ready to break out. Facebook, MA Hugging, so when I see these things, I'll jot it down on the screen, on the chart, and here, pattern of higher lows. You have it here. What's going on is that you have the sellers and buyers that are going back and forth, back and forth, back and forth. Here at the very end, the sellers are running out of supply, and or the buyers are just sucking everything up, and they're on a little bit more aggressive than they were. Nvidia, similar situation here as well. So then you want to create these things so that way during the weekend you can go over these things, and you're able to know exactly, you start to to really know internally what these things look like, these patterns. Here is the best performing stocks on a year-to-date basis. Fresh momentum. The stock was dead for many years here near a 52-week low. Then it has a huge move, 116 million shares. It is a biotech stock. It might have been something. And then 15 to 20 days later, you start to see the action starts to tighten up. The volume starts to contract, and then you get the opportunity here, down 1, 2, 3, 4 days in a row, prints an inside day. Once it goes through that high, is off to the races. You take a look at, what's the other one? VXRT, which is another big winner last year. Same as all the others, trading near 52-week lows, nothing going on. It was just dead. It was a dead stock. You can see that here. Then it had a really big move on tremendous volume. And then 10 to 15 days later, you get this sideways action. It starts to tighten up. It prints an inside day. Then it's off to the races. So the 4x3s comes from there. And when you look at the best performing stocks on a year-to-date basis, if you go back, you're going to notice the same pattern. All right, so here's AMC. You don't see it that well, but here's AMC trading near a 52-week low. Okay, you always hear all these people talk about don't buy 52-week lows, or just look at stocks near highs. But this move started from a 52-week low. And then here, the purple is when the stock was up 4% or more on 3 times the average daily volume. So I changed the colors here. The inside day is the yellow. Purple is when it had a 4x3 day, and you might see a light blue like this. That's when it prints an inside day on the lowest volume in the last 10 days. So this is the reason why the scan is gonna show you all the stocks that more than likely are going to be in play for the next 40 days. Look at MOXC, similar situation. If I go back here, the stock is trading 110,000 shares. It's the second biggest year-to-date winner so far this year, up 2,000%. It's trading at $1.50. Okay, so go back and read all those books that tell you only buy 52-week highs, only look at stocks near highs, only look at stocks above 15, or they got to make money. It all depends what your time frame is. The longer your time frame, the more you need a story, you need earnings and numbers. But if your time frame is less than 65 days, which is a quarter, then to me, earnings don't matter. Okay, because if you have a stock that's earning a lot of money, it has great sales growth, whatever the case may be, and then it goes down 7% and you sell it, then what about those great numbers? The numbers haven't changed. The quarter's not over. What's the point, right, of looking at numbers if you don't hold through earnings, or you don't hold an entire quarter to see if things change after they report their numbers, right? So MOX, whatever this is, MOXC, whatever. And you can see here, how has a huge update here on 54 million shares. What happens? 1, 2, 3, 4, 5, 6, 7 days. Look how it starts to tighten up right over here. Has another move higher for 4 to 5 days, and then it starts to tighten up again. Has another move higher, and it starts to tighten up here again. So what I want to do with these trades, very simply, is that I want to take advantage of these days over here, 4 to 5 days. I want to sell it, and I want to get involved in something that's just getting started. VTNR, same exact situation. 1/6/2021, the stock is trading at 83 cents a share. A million shares. Big move here on big volume. Really doesn't set up again. But here, it's got some tremendous moves. 256 million shares, 231, 124. And then here it sets up. How many days? From here, this is the 14th trading day. So you get that 10 to 15 day consolidation. This is fresh momentum. First time it's touching the 21-day moving average. You see here how volatile the stock is. Wide ranges at the very end. Look how it starts to tighten up. And then it's off to the races. And if you look at it again, here's that little blue candle. Here's an inside day on the lowest volume in the last 10 days. Right? So this stock traded 1.5 million shares. The average 20-day volume is 5 million shares. This to me is a setup for tomorrow, going through 1053. Buy stock 1063. Now here's the key. This is the second time that it might test the 21-day moving average. That 21-day moving average is all the way down to 940. Now, typically in a situation like this, I'm going to put my stop right over here at 977. I know it's a little wide percentage-wise. However, these stocks, they move. So it's okay to have a wide stop. And if you're risking the same amount of money, if you're risking $1,000 in each trade, not investing 1,000, but risking $1,000 in each trade, whether that stop loss is 10% away or 25% away, it's still the same $1,000. So in a situation like this, I would hate to get stopped out of the stock above the 21-day moving average. I want to give it at least to the 21-day. This is specifically for this type of setup. And what we have here, we have fresh momentum. This is the second, you can call this the second setup. Here's the first setup that you can take advantage of. You can't, this initial move here, you're not going to catch. You're not going to catch this move unless for some reason you own the stock throughout all this. You're not going to catch this. If you're a day trader, you might catch the next 2 days. For us, what we're waiting for is we're waiting for that consolidation or that pullback, the tightness, and then we want to get involved. This is the first day that we would have, got involved in the stock right over here, going through this high. This is the second time that is setting up. So this is a good setup. So 1053, initial stop loss is going to be 940, right? And then if the stock moves higher, the 21-day is going to start to inch higher. You're going to be able to raise that stop a little bit higher, okay? But here's the same story, guys. Let me just repeat this one more time. And those of you who have been following me for a long time know that this is the same thing from many years ago when I used to do the stock of the week, right? And I used to write these write-ups. And it was always the same exact thing. This is a momentum play. This was Axum, AXSM. Fits the bill of all of our stock of the week plays. It had a catalyst that drove the stock higher on big volume. To be more exact, the day after the phase 2 announcement, Axum traded 51 million shares, which is 5 times its current flow of 11.4 million shares. Since then, the stock digested the move by trading sideways. There hasn't been much interest in selling the stock up here. As you can see in the chart, The stock printed an inside day yesterday on the lowest volume, 285,000 shares since the catalyst. This is typically what happens right before the stock begins its second leg higher. Same thing. That's the reason why that 4x3 scan should be your main scan. That should be the scan you should be going through every single day looking for these type of ideas. It's not going to keep you out of losers, but it's going to get you involved in the best performing stocks in the short term, okay? And by the way, when I say tie stops and Y stops, I don't recommend, for the most part, Y stops in these stocks, in these AMC, whatever, these no-name small cap companies. And the reason why is 20% is just not enough. Over here, the stock had a 31% pullback overnight. So that 20%, you might get lucky every now and then, but more than likely, it's not going to work as an initial wide stop, as an initial stop, because the problem is, if you buy the stock and give it that wide stop, the stock is going to make a move like it did here, but then you're going to end up giving a lot of the gains because this pullback here was roughly 30%. You're going to give up a lot of the gains. So with these stocks, you want to sell on the way up. If you want, what you might want to do is leave 10 to 20%, leave a piece 10 to 20%, put a 20% trailing stop, and hopefully you get lucky, and you basically got a free trade, okay? And that can make a difference if you do it with every trade throughout the entire year. What do we have here? DXLG, the Destination XL Group, whatever this is. I wonder if this is the retail company that sells extra large clothing. The same thing. Here's a stock trading near the lows, 38 cents a share, trading 3 million shares. And then suddenly it has a couple of setups on a whole bunch. SAVA, Savla, same exact thing, trading at 773. This stock wasn't even trading. Look at this. Not trading at all. Suddenly, news comes out, phase 3, 316. The Alzheimer's drug looks very promising. The stock goes up, it goes down, very volatile. And then here at the very end, let's just look at the time. Roughly 27 bars, 27 trading days. Look at the tightness. 317 long, 54.73, down 3 days in a row, up today through the high. 4x3 scan on the lowest volume day since the gap higher. There's the setup. Had one big update, no follow through, but then eventually it starts to set up again. ANVS, very similar story to Sava. The stock is trading 93,000 shares, nothing at all. Here is the big volume days right over here. Here you start to see the tightness, not much, but here you get another big volume day. Here you get the pullback down 3 days in a row. This would have been the trigger right over here through this high 47.60 with a stop over here. So you want to wait for the stock to set up and give you a good buy stop and a good sell stop. The sell stops, the initial sell stops should always be at a level that's going to invalidate the chart pattern within your time frame. That's important. Okay. If for some and when you raise your stop, you can raise it based on the chart, or you can raise it based on what it is that you're looking to get out of the market. Okay. If you're looking to keep as much as possible, you start raising your stop for no apparent reason, then you're gonna get stopped out within the noise. And if that stock stops you out and then it continues to go higher, then you can't blame the market. You have to blame yourself. Okay. Your initial stop should be at a level where it validates a chart pattern. What you do afterwards, raising the stop and taking some off the table, that's completely up to you and what you're looking to accomplish with your trading, okay? I am looking to take advantage of the move higher. And then I want to take that money before the stock moves sideways or it goes down. I want to take that money and get involved on the first day of a potential multi-day move. If you guys read the IBD book or you read their study sessions, years ago they said that although in the books you see every single setup or every single example that they have, you look at all these things, the stocks go from 15 to 170, and you know, they mark it up. I bought here, I bought there, bought here, bought there. When you read online their little study pages, you go to IBD study, whatever the case may be, their advice is you want to sell most of your stocks when they're up 20 to 25%, because usually when they go up 20 to 25%, then they go into some type of consolidation, sideways to down action, and you do not know what's coming after that sideways to down action. So you want to take it off 20 to 25% and then get involved with something that's just getting started, okay? What I want to do is sometimes the way the market is trading nowadays, that you get these small bursts higher and then the stocks go sideways. The type of return that you get within the burst, who knows? It could be 10%, it can be 2%, it can be 15%, it can be 20%. It all depends what's going on with the market and how stocks are trading within this current market environment. You just don't know. So you take what the market gives you. If the market only gave you 3% in the next 5 days, then that's what you take. And then you get involved with the next one. If it gave you 20% that very first day, rest assured that you better take a lot of it off that first day, okay? MRIN. Now this stock eventually more than likely is going to set up. This is very volatile. But eventually what you're going to see is you're going to see the tightness. It's going to start to tighten up like all the other stocks. And then it's going to give you a nice risk reward setup. TCAT, same thing, guys. Stock is trading 83,000, $1.79 stock trading 83,000 shares. 83,000 shares. Then suddenly it's got these big moves and big volume. And then eventually you're going to get the setup 10 to 15 days later, more than likely, once you start seeing the stock start to tighten up. Okay. Can you talk about when you're moving your stop? Sometimes before the open, sometime early after. There's no time. There's no specific times when you're moving your stop. Either the stock allows you to move the stock up, right? Or it doesn't. That's it. It's not like after a certain time, oh, it's okay to move the stop after, 11:36. No, right? It's and look, let me just tell you what I own, and based on the setup that we have right now, on what's going on with the market. If you take a look at the other day, I posted we had 1,064 names down 3 days in a row or more, or something to that effect. And then we had 2,316 stocks making. So this is the whole point about not looking at the indices. If you take a look at the IWM, this thing has been trading sideways for the last, whatever it is, 5 months. Nothing crazy. You take a look at the composite, printing new highs every day. SPY, printing new highs every day. But just the other day, I think it was Thursday or Friday, we had 2,316 stocks making fresh 1 month lows, which is a tremendous, that's a big number. That doesn't happen often. On Thursday, I believe, or Wednesday, we had 1,064 stocks down 3 days in a row, and the indices are pretty much at the highs, right? So when you get that type of spike in stocks down 3 days in a row and fresh 1 month lows, what usually happens, you get a dead cat bounce. You get a bounce. And that's the reason why here it doesn't look great. Oh, the IWM is below the 50-day moving average, and it's Friday, and you don't want to buy before a weekend. But this setup was a very low risk setup. Okay. So look, I bought this. Let me tell you what I bought on Friday. RKQ. Bought the stock at 82.58, right? That's above this high right over here. Stock is down 1, 2, the ETF is down 3, 6 days in a row, okay? This is one of my favorite scans. Also, stocks down 3 days in a row or more, because if you go back and look at the data, stocks that are down multiple days in a row or more outperform in the short term. They outperform stocks that are up 4 or 5 days in a row. The stocks that are up 4 or 5 days in a row underperform a week later. That's the reason why it drives me crazy when people are looking at breakouts from a stock that's already up 5, 6, 7 days in a row. And oh, it's a great breakout. It's not a great breakout, not in the short term anyways. So here's a situation where we have a pattern, right, of lower highs and lower lows. That's the pattern here. Here's a high, lower high, lower low, lower high, lower low, lower high, lower low. We finally break that pattern, okay, on the way up, right, by going to the previous day high. That was the buy stop. My initial stop was this low, right, because that's where it's going to invalidate the pattern. It's this low here. The stock made a move higher. I own it at 82.58. It's trading at 83.42. This stock gave me the opportunity to raise my stop. Now my sell stop goes from 80.02 to 82.58. I'm sorry, it goes from 80.02 to this low 82.16. I know this as of the close of Friday. I don't have to wait until 11:30, 11:16, 12:30. It gave me an opportunity to raise my stop to this low, okay? And if it stops me out, that's great. But the way, in my eyes, the way I look at it, my initial risk was 80.02. Now it's only 82.16. My initial risk here was roughly $2.56. I just reduced my risk to roughly 30 cents. That's a win in my book, okay? Body, similar situation. I think every stock that I took on Friday was down 3 days in a row or more. That's what I'm looking for. So Body, bought the stock at 9.14, down 8 days in a row, up today through the high. Where's the pattern? Lower highs, lower lows, lower highs, lower lows. Here's the break of that pattern. My initial stop was 8.53. It broke the pattern. Now I'm going to raise my stop from 8.53 to 8.85. I knew that from 4 o'clock on Friday. So I don't have to wait until 10:16, whatever the case. It just gave me the opportunity to raise the stop. CCIV, down 1, 2, 3, 4, 5 days in a row. Long, 25.67, which is roughly 10 cents above this high. A pattern of lower highs and lower lows, lower highs and lower lows. And if you study this scan, what typically happens is that you go from a pattern of lower highs to lower lows to a pattern of higher lows and higher highs. It's a complete change of pattern in the short term. So here, I own the stock at 25.67. Now, I can raise my stop to 25.24. I can do that. But I believe that this stock did not give me enough room to raise my stop. This stock can tick down to 25.24, 25 cents, and then stop me out. So I'm not going to raise my stop for CCIV. I'm not going to go above. I'm not going to raise it like I did with Body and RKQ. I'm going to leave this as the initial stop. If I'm concerned about losing money, look, when I put on the trade, I've already accepted that it could be a losing trade. So whatever it is that I'm risking, if I'm risking $1,000, I've already accepted that I can lose that $1,000. Doesn't matter. So here, if for some reason I don't raise this one and I take a full stop on this one, but I reduce my stops in the two others, I'm fine. So this one, I'm not going to raise my stop unless it has a big update. It might have a big update tomorrow, whatever the case may be. Then I'll raise it to right underneath this over here, okay? CHPT, here's another one, down 1, 2, 3, 4, 5 days in a row. Bought the stock at 28.47. My initial stop was right over here, 27.09. The stock closed pretty much at the low. It didn't do anything wrong. I'm not going to raise my stop to 27.70. Maybe I might have to take a full stop on this one. I'm fine with that, right? So it has nothing to do with time. Certain stocks are going to give you an opportunity to raise that stop. Certain stocks won't, okay? If for some reason I wanted to be really rigid and I believe that if a stock fails on the first day, then it's no good. If I really believe that, then I'll raise my stop, right? But I don't believe that. There's a lot of randomness that happens in certain stocks or in the market at all. A lot of random stuff. So here, this didn't raise my stop, so I might have to take a full stop. Who knows? ERX, same exact thing, down 1, 2, 3, 4 days in a row. Pattern of lower highs and lower lows. Bought the stock at 26.83. My initial stop was right over here at 25.22. This stock had a nice move higher. I can raise my stop to this low, 26.05. Right? That one gave me the opportunity. Same thing with 50. Gave me an opportunity to raise my stop to this low. Jemiah. Yeah, gave me an opportunity to raise my stop to this low. LMND, same thing, gave me the opportunity to raise my stop to this low. And what you want to visualize what this stock will look like if it broke through this low. I mean, if you visualize this setup right here, if this stock broke to this low right over here, it's going to look like a bad setup, okay? So there is no black and white in trading. You can do a lot of things mechanical, but there's certain things that you have to adjust. There's certain things that come with experience that you can't just make it as a black and white thing, okay? But if you're concerned about losses, then you need to reduce size until you're comfortable, being stopped out 10 days. Listen, every time we go through some sideways chop action, I say the same thing over and over again. I said, look, you got to be able to make this your own. You got to be able to do the homework and make all the scans and the way these things trade your own. You have to internalize these things. So that way, when you go through these drawdowns, you're not losing faith. You're not going from this place to this place to this place to this place, because what usually happens is that this is just the life of an investor for the most part. Behavioral finance is something that's not talked about enough. Here's what happens. ARK was a perfect example. ARK has a tremendous move higher, and they take more money the first month of this year than they did in the last 5 years. People always believe that because something went up 100%, that when they buy it, the underlying instrument is going to replicate exactly what it did 6 months ago. And they always chase. And then this happens. Then if for some reason or another, the sideways action lasts a very long time, what's going to happen? They're going to sell, and then they're going to look for whatever was up huge just recently and get involved in that. When you're looking to raise money as a hedge fund, as a broker, as a financial advisor, believe me when I tell you, all you need to show is great performance in the last year, and people are just going to chase and throw money at you exactly at the wrong time, exactly when typically you're going to go through some sideways to drawdown action for the next 2 to 3 months. And the cycle is going to repeat itself over and over again. If you take a look at ARK, you go back to ARK. ARK traded sideways. ARK had a big move. See if you can see it here. ARK had a big move, and then it traded sideways here, 47.85, June 18, 2018, and it went sideways for roughly until 5/5/2020, when it finally broke that 50 level. Okay? had a big move, tremendous sideways action, and then it had a big run, and chances are that it'll probably go through some sideways action for a while. Doesn't mean you're not going to have opportunities, but the point is that uh, you don't want to chase, and you don't want to jump from place to place, because the only thing you're looking at, people don't even look at, they don't even look at how you're making the sausage. They just want to know how well you did a year ago. And if it's the higher it is, the faster they'll throw money at you. Let's see if we got any more questions. For RKQ, gapped up. Did you buy pre-market? RKQ did not gap up. Maybe you did. I did not buy a pre-market. I did not buy a pre-market. I bought it, I think midday. I mean, RKQ, it gapped up and it came down. I probably bought it, 9:45, 10 o'clock in the morning. So I did not buy a pre-market. I rarely do I buy any stocks pre-market. I will sell pre-market, we get a gap up, but I do not buy stocks for the most part pre-market. If for some reason I have a stock on my list and it gaps up, I just let it go. Any more questions? Okay. So for those of you in the room, I already sent over, I sent over the link, the 4x3 link with the top 4 and also the top 400 stocks. The top 400 stocks, very simply, again, what we're looking at the top 100 names, best performing stocks on a year-to-date basis, on a 3-month basis, on a 6-month basis, and on a 1-year basis, right? That's the top 400. What I did this week, we have 277 names. What I did this week, instead of taking the top 100 on a yearly basis, I took the top 150. And the reason why is because I noticed that more than half of the names in the list are already on the 4x3 scan. So I wanted to get a little bit more diversification. So I went out there and I took the longest time frame, which is the yearly time frame for us, and I took the 150 names instead of 100. But again, all right, hold on. Sometimes the stock are giving us 10 to 15, 20% over 3 to 5 days. Other times, like now, the stock are only moving 3 to 5% on day one and reverse quickly. Yes, listen, the market changes. That's the reason why the rolling 5-day watch list is so important, because it tells you how things are trading now. We have different market environments, and that's the reason why I don't believe in price targets, or I don't believe in, it's got to go up 20%. You're not going to get, in certain markets, you're not going to get 20%. In certain markets, you might be lucky if you only get 5%. So you have to adjust. And the only thing that tells you how and when to adjust is your rolling 5-day watch list. Okay, that's what tells you. I adjusted last week. Why? Because trades weren't working out for me. And again, and once you go to the rolling 5-day watch list, you have to be honest with yourself. Okay. I didn't do well this week. Okay, but did you miss this one, and this one? You got to be honest with yourself. You got to take everything into account. Why? What about had I taken Amazon? For some reason, I don't like it, and someone on Twitter said that Amazon, it's an old growth company, and typically old leaders don't become new leaders, so I didn't take the trade. And had I taken that trade, instead of being down 1%, I would have been up 0.5%. So now, is the market choppy because of the market, or is choppy because you failed to execute properly? Right? So you have to make sure that you balance these things out. Okay? I reduced my size based on my recent trades. And also what I started doing this year for the first time, and I got this from someone. I don't know if you guys read the last Market Wizard book, Unknown Market Wizards. which I didn't think it was a great book, but the last chapter was one individual that all he does, it's all mechanical. And I know the guy. I've exchanged a very nice guy. I've exchanged emails. He sent me over years ago his entire, he did a presentation and he sent over the entire presentation. And that last chapter, he wrote, for the first time, he started using moving averages on his net asset value on his account. And I started doing that as well. I started using the 5-day moving average, the 10-day moving average, and 21-day moving average. So that kind of like tells me if I'm underneath all three averages, I need to probably reduce size. So I started tracking that. And right now, I'm just barely above my 5-day moving average. And again, and what it is, let me just show you. Right, so here I had another little drawdown based on one stock, and I'm just barely above. No, not Pradeep. No, he was in the last book, Unknown Market Wizards, the last chapter. What's his name? Mars or Marston Parker. But either way, so as I read the entire book, the only thing I got, yes, Parker. The only thing I got from the book, from the entire book, was that one little thing about putting the moving averages on your NAV. And I said, all right, so let me play around with it. I emailed TraderView, which I use TraderView to import all the trades. And I asked them if they can do that. They said, it sounds great, but we can't do it right now. So what I did was I just took all the data and put it on the Google trade sheet, and I started tracking it myself. And that's it. So that's the only, so that's, that's something that, so now if I'm below the 5-day, 10-day, 21-day moving average, that might, make me reduce size. But at the same time, I also have to realize that, hey, part of that big hit was ALT, which that very same day in the room, I said, look, you got to be ready for everything. If you trade long enough, you're going to walk into a gap down. You're going to walk into a gap up. You're going to walk into a buyout. You're going to walk into a fraud. You're going to walk into everything. And that very same day, I bought ALT, and at 4 o'clock, the stock was halted and it was down, whatever it is, 50%. Right? It happens. Right? So I need to, so if for some reason all the other trades that I took were acting well, and I was below those averages, I would say to myself, look, that's because ALT. If ALT was a regular loser, I would not be below these averages. The market is still doing well. But that wasn't the case. Are you looking at RS relative strength? No, I don't look at relative strength. I mean, listen. Now, you've been in the room for a long time. You know what I do. And if you don't know what I do, then there's an issue because I post the same thing over it. I don't look at RS relative strength. I don't look at any of that stuff. Or what sectors are moving now to find the stock that are in play and have more potential. No, I don't look at it. This is the scan right here. Listen, if you're struggling right now, reduce everything to one single scan, one single setup. I don't look at relative strength. All right. If you dig deep into relative strength, you will understand when that works best. That works best when the market is in a big correction, like it was in March. It doesn't work on an individual basis. Okay. What you want is you want to look at the stocks that are up the most on a year-to-date basis. Okay, this tells you the entire story. This is going to break all the myths in the world. Every single myth that you read about, this is going to break it for you. You jot down the commonalities, and if you go to my blog, where is it? Let's see if it comes up. Let me just type garbage. I think I wrote a post in regards to, I think I wrote a post about this years ago, where all these stocks, for the most part, that are the best performing stocks on a year-to-date basis, they all have a few things in common. Most of them started near 52-week lows. A majority started the year under $20 a share, under $10 a share. I just put this on Twitter the other day. A majority of them don't even make money. No one knows who they are. So we know AMC, whatever. Who knows this company? Who's MOXC? Started the year, $1.38. From where? 52-week low. VTNR. Who is VTNR? EPS minus 42%. Started the year at 70 cents. Where's the relative strength in this? Look at this, 52-week low, doesn't even trade. DXLG started the year 2021 at 28 cents. Where's the RS on this? Sava, who is Sava? Started the year, $8.42. They don't make any money. There's no RS strength here. Now, it probably has it now, right after the fact, but this gave you, with this scan, it gave you the opportunity when it first got started, when it first hit the map. All right, Newegg, whatever this is, Gamestop, you know, I'm not going to talk about Gamestop, but GameStop started the year where? At $17, $15 a share. MRIN was trading at $1.58 just the other day, trading 258,000 shares. So you have to be able to study the best performing stocks on a year-to-date basis. This is going to give you all the things you need to know. And you start to jot these things down. The top 100, how many started the year under 20? The top 100, how many stocks were near 52-week lows? The top 100, how many are name brand companies? The top 100, how many of them are actually making money? So it tells you everything, right? It tells you everything. The relative strength works when you've gone through a tremendous bear market, and then you start seeing certain stocks that are trading near highs when the market's trading near lows. That only happens, you know, every now and then. So I don't use RS. This is my main scan and my recommendation to everyone. This is the reason why I post a scan every single week in the room, every Sunday. My recommendation, this is the scan that you want to go through every single day. This one, the top 400, and this is where you want to look for your setups. You want to find opportunities like this. Here's a stock, fresh momentum, big up days and big volume, down 1, 2, 3, 4 days in a row, right? This stock was on the list, not on the list. I didn't put the stock on the list, but here would have been here above, going above 11.95. The next day it goes up roughly about 40%. It doesn't matter if it faded because it gave you more than enough to chew on the very next day. Okay, let me just go through a little bit quicker. EXPR, Express. KOSS, who is KOSS? Where was it? 52-week low, trading at 315. ATOS, who is ATOS? Started the year at 95 cents near 52-week lows. Look at this. It's now number 15, up 460% for the year. ENTX, who's ENTX? Started the year at $1.19, okay? But what's going to happen is, very simply, the stock is left for dead for many years or many months. Suddenly news comes out. The stock goes up on tremendous volume. 10 to 15 days later, you get the consolidation, tightness of action, volume contraction. Boom. You want to go through that high. That's it. That's all you need to know. And that's over here. These videos that I post every single day in the room, how I look for daily swing setups. These videos are almost 6 years old. It's all here. And the other day, Best short-term swing trading video, it's all here. Best scan to find future winners is all here. And it's all the same exact thing. And the other day, as I was listening to one of the videos, the first 3 minutes says it all. Listen to the first 2 minutes of one of the videos that I post every day. When the first 2 minutes, the setup is explained. You have a stock that was dead, barely trading, suddenly had a huge update, a huge volume relative to the stock, consolidates for 10 to 20 days. It tightens up. At the end of the consolidation, maybe you get an inside day, volume dries up, and then once it goes through that high, it's off to the races. That's it. Here's a perfect example, VTNR. Perfect example. Trading, 1.5 million shares, 248,000 shares. Where is it? Near a 52-week low. Look at this. Sideways for all this time. You're not going to catch this move, nor this move, but here's a consolidation. 14 days of sideways action. This stock was on the list going through this high. 744 has a big move. Now, again, inside day on very low volume. This is a good setup. It might work, it might not work, but this is the type of setup that you want to put on. The outcome of these trades are unknown. And this might work, and it might not work, and it maybe didn't work for some random reasons. But this is the type of setup that if you see it 1,000 times, you want to take it 1,000 times. Half the times you're going to be wrong, but the 50% that you're going to be right, you're probably going to make more money than what you lost on the 50% that you lost those times, if you execute properly. Any other questions, people? All right. Thank you for your time. And I'll see you guys back tomorrow. And hold on. Weekly setup. Sometimes you share. Is it sometime where I'll check the weekly? Right. So, all right. Someone's asking about weekly setups. And every now and then, I'll look at the weekly charts. And by the way, the weekly charts, very simply, you need to be able to create scans based on the way the market moves. So the scans that I have that I use for a daily basis are the same ones that I use for a weekly basis. It's the same thing. It's just based on market structure, the way the market moves. So the scans are the same. So on a daily basis, if I'm looking for stocks down 3 days in a row, on a weekly, I'm looking for stocks down 3 weeks in a row. MDB down 1, 2, 3 in a row, right? Gamestop, looks like a good setup, right? So for those of you who, again, you had the tight stops and you had the wide stops. Unfortunately, for most people, they have an issue taking stops, quick stops. If that's the case, you need to know yourself and say, oh, listen, I can't do the daily setups because I don't like to get stopped out so quickly. There's certain people that they're okay losing 10% in 6 months. They're not okay with losing 10% in 1 day, right? 6 months, they're fine with it. Not 1 day. So if that's you, then go on to the weekly setup. So here's GameStop, right? GameStop, this is based on market structure. It's down 1, 2, 3, 4, 5 weeks in a row. What you have here for the most part is a pattern of lower highs and lower lows. So the buy stop here is going to be 204.77 plus 10 cents, 204.87. With a stop at 177, your initial stop is going to be 177.56, right? So you can do that. And I'm looking for the same exact patterns. UPST, not bad. Okay. And, down 5 weeks in a row. Buy stop will be 123.58. Initial stop 110, right? So I don't look for weekly setups as often as I do, as often as I should, or it's because of my personality. All right. If I can get a stock that's going to give me 10 to 15% in 5 days, I'm going to take that over a weekly setup that might give me 10 to 15 days in a few weeks. Okay. But that's based on my personality. For some reason, I felt like, hey, I need to put more money to use more often, and I need to be more invested. Then I would do weekly, right? Because you want to diversify yourself if need be. Uh, with time frames, you can diversify with daily setups and weekly time frames. If you don't have time for the daily setups, spend time with the weekly setups. Okay, here, inside day, inside week. Now this gives me all the stocks that printed an inside week. NR7, same thing. And why are we choosing this whole down 3 days in a row? Okay, uh, I'm gonna tell you why. I don't think I've posted this in a room lately, but let me see if I have it here somewhere. Let me see if I have it here somewhere. Just give me a second, guys. Okay. Oh, come on. All right, so whatever. This it's not coming up for some reason. This was a study done by might have been Larry Connors, right? And they just did a study of all the stocks down 3 days in a row, 4 days in a row, 5 days in a row, and they said, okay, the ones that were down 5 days in a row, they outperformed 5 days later. Down 6 days in a row, they performed better than all the others, whatever's a week later. But let's just do this. Let's look at the best performing stocks, all the stocks that are up 25% or more in the last month. They're only 87, which is very low, right? Considering where the markets are. 87. So over here, these yellow check marks, it gives you all the stocks that at some point in the last month met the criteria of down 3 days in a row or more and up. Okay. So out of those 87, 53 at some point had that setup. That's 61% of the best performing stocks on a monthly basis at some point had that setup. This is how you create scans, by going through the best performing stocks and jotting these things down. Now let's look at them. Let's see. Let's see where it happened. TTD. You see these yellow cones right over here? Yellow cones, that's when it happened. 1, 2, 3. Here's the update. So you get a pattern of lower highs and lower lows, and then suddenly you get a pattern of higher lows and higher highs, that you get a higher high here, right? And you get a higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. It finally breaks it here. So if you wanted to trade this setup and you wanted to do it mechanically, then this is how to do it. This is how you would do it, where you raise your stop for this specific setup. If you want to do it mechanically, you raise the stop for this specific setup to the previous day low. Okay. And in the room every day, I post these setups, right? Or these charts, right? Or these notes, right? Here's the initial stop, raised, raised, raised. This is for this particular setup, because as you go through this, you will realize, and you study this over and over again, you will realize that when this works, what usually happens more often than not is you go from a pattern of lower highs and lower lows to a pattern of higher highs and higher lows. Let's look at MOX, uh, MOXC. When did it happen? Where is that yellow? Happened right over here. It's a long time ago. When did it happen again? Right over here. This one didn't go through the high, but I just see another one. When did it happen? Right over here. When did it happen? Right over here. So they're all not going to work, but as you go through this, more often than not, you get the lower highs and lower lows. Then you get a pattern of higher highs and higher lows that might last. I mean, this one lasted roughly 1, 2, 3, 4, 5 days. You would have been stopped down day number 6. Day number 6 was the first time we went to the previous day low. Space. This one just getting started right over here. OPNT happened right over here. This one didn't work out that well. But this is the way you start to understand the way the market works by looking at the best performing stocks and jotting these things down. And after you jot these things down, what you want to do is, let me just show you. Just go to Google and create this. Year-to-date winners, pullbacks, ideal setups, basis, 2017 trades, year-to-date winners, basis. All right, you go to basis. 7 months of sideways actions, MA hugging. Here you have a pattern of higher lows right at the very end, right? Let's see, what else do we have here? DHI, 6.4 months of sideways action. Here you have the MA hugging. Then at the very end, the buyers are no longer waiting for it to get back down here to the bottom of the base. Either the buyers are being more aggressive or the sellers are just running out of supply. So basis is something else that you should, be on top of. LC, right? So where's the relative strength in LC? Trading near 52-week lows. The bases that are trading near 52-week lows are even better. Those are even better. So here's what, look, I jotted it down. MA hugging, up, down, up, down, up, down. And here at the very end, at the very top of the range, it starts to tighten up and off to the races. If for some reason you missed this first initial move higher, it sets up again right here, 1223. Fortune Brands, same thing, 7.2 of sideways action, 7 months of sideways action, MA hugging. So you want to be able to take, snapshots of, these patterns, so that way you can internalize them, and when you see them, you take them. And if you look at all these whatever big winners, for the most part, the bigger the base, the higher into space it goes, the longer the move will last. So you want to, you always want to be on the lookout for something that's been trading sideways for a long time. And trust me when I tell you, it does not have to be near highs. If it's near lows, that's even better. CCL, AAL, AMPY, 10 months of sideways action. Here's a pattern of higher lows at the very end. So you start taking these notes. You start jotting these things down. You start making these things your own. LPI, same thing. This stock is trading at $80 now. 1 for 20, reverse split, basing for 9 months. Here at the very end, look how it stays up here. No longer has an interest in going down to the bottom of the base. Here, I'm writing down 21.7 drawdown, 20% drawdown, because, with some of these things, you want to give it room. So you always have to ask yourself, hey, what's the proper amount? 20%, 25%, whatever it may be. Previous trades or previous examples might give you an idea of what type of trailing stop you want to give these long bases. REGI, 2 months of sideways action. That's not a lot. LC again, MG, 8.5 months of side. So this is what you want to do. Okay. Look, I even had Amazon here. It's tracking Amazon for months. Netflix is another one that's going through a huge base. Deckers. This is what you want to do. So you can read all the books you want and hop from this place to this place, relative strength, whatever it is, but nothing is going to give you more useful information than studying the best performing stocks on a year-to-day basis. And with that, I am going to go. I said goodbye 7 times already. I'm done, guys. So thank you for your time, and I'll see you guys in the room tomorrow.